Hi. Let's learn about the amortization of intangibles. Amortization of intangibles, also simply known as amortization, is the process of expensing the cost of an intangible asset over the projected life of the asset for tax or accounting purposes. Intangible assets, such as patents and trademarks, are amortized into an expense account called amortization. Tangible assets are instead written off through depreciation. The amortization process for corporate accounting purposes may differ from the amount of amortization used for tax purposes. For tax purposes, the cost basis of an intangible asset is amortized over a specific number of years, regardless of the actual useful life of the asset. Intangible assets are non-physical assets that can be assigned an economic value, such as patents, trademarks, goodwill, and trade and franchise names. The Internal Revenue Service allows most intangibles to be amortized over a 15-year period if it's one of the ones included in Section 197. When a parent company purchases a subsidiary company and pays more than the fair market value of the subsidiary's net assets, the amount over fair market value is posted to goodwill, an intangible asset. Intangible assets can also be internally generated by a company's own research and development efforts, further increasing the company's value. The amortization process allows the company to write off a part of the value of that intangible asset annually, according to a defined schedule. Tangible assets are expensed using depreciation, and intangible assets are expensed through amortization. Depreciation generally includes a salvage value for the physical asset, while amortization doesn't take into account a salvage value. For accounting purposes, a company can choose from 6 amortization methods: straight line, declining balance, annuity, bullet, balloon, and negative amortization. For tax purposes, there are 2 options for amortization of intangibles that the IRS allows: straight line and the income forecast method. For depreciation of physical assets, the IRS only allows the modified accelerated cost recovery system. Assume a construction company buys a $32,000 truck to be used for contractor work, with a useful life of 8 years. The annual depreciation expense on a straight-line basis would be calculated as the $32,000 cost basis minus the expected salvage value of $4,000, divided by 8 years, resulting in an annual depreciation of $3,500. On the other hand, if a corporation pays $300,000 for a patent that allows exclusive rights over intellectual property for 30 years, the firm's accounting department would post a $10,000 amortization expense each year for 30 years. The term amortization of intangibles describes the process of expensing costs associated with intangible assets, such as patents and trademarks, over the course of their life for tax or accounting purposes. These assets are expensed into an amortization account. The most common way to calculate the amortization of intangibles is by using the straight-line method. Amortization is calculated by taking the difference between the cost of the asset and its anticipated salvage or book value, and dividing that figure by the total number of years it will be used. Amortization of intangibles appears on a company's profit and loss statement under the expenses category, as well as on corporate balance sheets under the non-current assets section. Here are 5 key takeaways. 1. Amortization of intangible assets is a process by which the cost of such an asset is incrementally expensed or written off over time. 2. Amortization applies to intangible, non-physical, assets, while depreciation applies to tangible, physical, assets. 3. Intangible assets may include various types of intellectual property, patents, goodwill, trademarks, etc. 4. Most intangibles are required to be amortized over a 15-year period for tax purposes. 5. For accounting purposes, there are 6 amortization methods: straight line, declining balance, annuity, bullet, balloon, and negative amortization. Hope this would help. Thanks for watching.